Hey everyone, welcome back to Corporate Decoder, the place where we decode the often confusing world of corporate filings. Today we're diving into United Guardian's latest 10K report, their annual financial checkup. Prepare for some financial twists. It's a bit like a roller coaster ride through balance sheets. United Guardian Inc., a smaller company, makes specialty ingredients. Think of things that go into your makeup, medicine, and even some things for sexual wellness. They used to make industrial products too, but they stopped that last year because it wasn't making enough money. In South America, they have a deal to sell those sexual wellness ingredients, but haven't seen sales yet in 2024. Scroll December 31, 2024, New Europe Keft. Alright, let's get into the numbers. This report covers their performance up to the end of last year. It's important to remember that these are their numbers, what the company is choosing to highlight. We will attempt to make sense of them. First, they tell us about what they do, their business, if you will. A key takeaway is their focus on coming up with new products. This is really important to stay ahead of the competition, especially with those cosmetic ingredients, and they use trade secrets to protect how they make their stuff. They're not getting patents, they're keeping it secret. Also, they have a trademark on Lubrogel, Ranitidine, Chlorpartin, excellence through innovation and Natrokin, excellence through innovation and Natrotin, excellence through innovation and Natragel, which is smart because that protects their brands. It is legally required for them to include the risks and uncertainties that may affect the company's business. These include the ups and downs of the economy, government rules, new technology, competition in pricing, and the success of new products. If all those things go wrong, that could really hurt their results. The company has 4 product categories: cosmetic ingredients, medical lubricants, pharmaceuticals, and sexual wellness ingredients. Cosmetic ingredients are things like loo gel formulations. These make skincare and makeup products feel good. In 2024, they sold a lot of cosmetic ingredients, around 45% of their sales. Big increase from 38% in 2023. They use distributors, companies that sell their stuff for them. Ashland is their biggest distributor, selling their products all over the world. Next up, pharmaceuticals. They've got Ranitidine, a prescription drug for urinary problems, and Chlorpartin, which is used as a topical antimicrobial, something that kills germs. These products made up 39% of their sales in 2024, which is less than the 45% in 2023. Then there are the medical lubricants. These are sold directly to companies that make medical products. These products are used in catheters, condoms, and oral care, basically making medical procedures a little more comfortable. Sales of medical lubricants were about 17% of their total sales, bit up from 16%. Most of United Guardian's business is in the United States, accounting for 84% of sales. Their biggest distributor, Ashland, buys most of their cosmetic ingredients, which counts as domestic, even though Ashland resells much of it internationally. Now for something interesting, their agreement with Ashland, their biggest distributor, ended in December. They were talking about renegotiating it and are hopeful they can execute by middle of next year, but there is no guarantee for now. That is something to keep an eye on. They are certified in the newest ISO standard, which says that their overall operations have the high level of quality needed to comply with ISO standards. The current certification is valid through July 2027. Research and development is a big deal for them, spending money to find new products and improve old ones. Research and development expenses decreased by approximately 2%, from 463 by approximately 2%, from 463 by some 992.24. Of course, the report contains information about cybersecurity, which is important since we live in the age of hacking and internet criminals. It is reviewed yearly by their board of directors. Their stock trades on the NASDAQ with the symbol UG. And get this, they declared a cash dividend of $0.35 per share. They actually declared a $0.25 cash dividend earlier in the year as well. It's always good to see when companies share the profits with the shareholders. Now for the financials. They took in $12.1 million, an increase of approximately 12%, but operating expenses increased by about 13%, from roughly $2 million to $2.3 million. Investment income increased by approximately 42%, from $306,651 in 2023 to $434,679 in 2024 due to increased interest income and holding more funds in higher yielding money market accounts. They reported a net gain on marketable securities of about $27,000, less than the $81,000 in 2023. They repositioned the portfolio to take advantage of the increase in interest rates. Now, let's examine their balance sheet. Assets equal liabilities plus equity. Where are they keeping all their treasure? They have about 12.6 million in current assets, such as cash and accounts receivable, about a 400k increase from last year. They have 1.9 million in current liabilities, a 400k increase from last year, which will need to be paid soon. Their retained earnings increased about 500k to 11.4 million. Their cash flow statements shows how cash moved through the company. Cash from operations was about 3.4 million, up a bit from 3.1 million, so they are doing fine making money and managing resources. They actually used over 2.5 million to pay out dividends, way more than the 459,000 from last year. There is information about significant accounting policies which can be important. One is revenue recognition, which means they can't just say they made money, they have to follow a set of rules. The report also contains information about new accounting rules. One that was recently issued requires disaggregation of certain expense captions into specified categories in disclosures within the footnotes to the financial statements, meaning more rules, more details, more expensive accountants. Finally, something to note is about related party transactions. They paid Ken Globus, their former president, for consulting services, and they paid accounting and tax services to a company where one of their directors is a partner. This isn't necessarily bad, but it is something to keep an eye on. So what's the overall picture here? United Guardian looks like a pretty solid smaller company. Their core business seems stable, but their dependence on a few key products and distributors is a potential risk. Also, there is an ongoing dispute with their major distributor, so we might see a future negative impact. But on the other hand, they make a lot of cash, have little debt, and are paying their shareholders handsomely. So now it's your turn. What do you think about United Guardian's future prospects? Let me know in the comments below. And if you found this breakdown helpful, please like, subscribe, and hit that notification bell for more corporate decoder content.